All right. With that little bit, I'll start with a series of disclaimers. That's one of the things we attorneys do best. First and foremost, I am not responsible for any of the graphics during the presentation, although some of them are fairly cute. To be clear, I'm not an accountant. I'm not a tax attorney. I do corporate transactional work, which involves a great deal of merger and acquisition work. But I'm not a tax expert, even though a fair bit of this discussion is going to cover tax topics. And along those lines, something that you're not going to get from me today is any discussion of complex tax strategies, such as converting a stock purchase to be taxed as if it was an asset transaction under Internal Revenue Code Section 338H10. That just was my full breadth of tax expertise right there, just saying that. I'm also going to assume for purposes of this discussion that the buyers and sellers don't have any issues in trying to convince minority stockholders to go along with the deal. We could have an extended conversation about the approval requirements for various transactions, liquidation rights in some circumstances to shareholders that don't want to participate in a transaction. I'm going to put all of that aside. Also not going to try to get into any sophisticated structures as might be applied in a venture capital transaction or with a private equity purchaser where they can do some very complex and strange things with really loaning money for as the purchase price as opposed to simply ponying up the purchase price. What we're going to look at today is a fairly high level, as in 10,000-foot level, view of an asset deal versus a stock deal, and really from a more practical perspective than anything truly technical. Okay. And with that long list of disclaimers, Joan, I'm all yours.
Okay, great. If you could just give us an overview of a stock sale versus an asset sale, and then we can get into some other parts of it.
Real basic. Stock deal, the seller is the shareholder, not the corporation itself. By definition, and I'll sort of take a step back after I say it, all assets are included in the transaction. It's not that you're picking and choosing assets to be transferred and not transferred. And most importantly, in a stock sale, the buyer is by definition acquiring all of the liabilities of the corporation. That is, all liabilities of the entity, whether known or unknown, are going to ride along with the transaction. That's a critical issue, probably one of the most important issues. Having said that, however, imagine a lawyer makes a statement and then immediately backtracks. There are ways to change those things. Many stock deals, the seller is going to hold back certain assets, such as personal items, artwork, cars, computers, things of that nature. Those can be either spun off or distributed out to the shareholder, the selling shareholder, before the transaction is closed. And also dealing with liabilities. There's a distinction to be drawn between the technical continuing liability of the corporation and how, well, what's the best way to put this? The economic reality. If I'm coming in to buy the stock of a corporation and there are potential liabilities, whether they're known or unknown, that I really don't want to deal with, but I still want to do a stock deal for some reason, I can provide for express carve-outs where the selling shareholder assumes responsibility for those liabilities, provides representations or warranties that no other liabilities exist, and then further backs that up with an indemnity obligation. Most of you are probably familiar with the term indemnity. It's like insurance, so that if a liability does pick up, the indemnitor, the person providing the indemnity, has to step in and protect the other party against that liability, just like an insurance company is supposed to do. With that, potentially there are protective provisions such as holdback of the purchase price, offset rights against promissory notes, or other mechanisms pursuant to which The buyer, who doesn't want to get stuck with the liability, will have recourse against the seller in case the seller does not perform on their indemnity obligation.
So it sounds like most buyers are protected then with language that their attorneys can put in the document in a stock sale?
You can make a stock sale look an awful lot like an asset deal in terms of what liabilities are or are not picked up by the buyer. The key is to having the provisions that clearly put the liability onto the selling shareholder, and then backing those up. The challenge that comes into play from the buyer's perspective is what happens if that seller, who's supposed to be responsible, heads off to Peru or doesn't have any assets left at the end of the day. Do they or do they not perform? The challenge being that if the seller does not perform and the buyer doesn't have assets against which to offset the liability, they can still be stuck holding the bag because that corporation that they bought has that liability.
Okay, great. And then an overview on the asset sale?
Asset sale, completely different seller. The seller is not the shareholder. It is the corporation. Typically, the assets get sold, liquidated, and then the corporation is dissolved and the sales proceeds distributed to the shareholder. It can involve the sale of all the assets or some of the assets. It's really a pick and choose situation. And I think very importantly from a buyer's perspective is that the buyer does not necessarily pick up all the liabilities. They will only assume specific liabilities, those that they want to have. Accounts payable, for example, might be something that the buyer would want to have. But what they get to do is avoid some critical potential unknown liabilities, or pick up liabilities only to specific dollar amounts. It provides a great deal of flexibility to acquire the business and know what you're getting into, or at least supposedly know what you're getting into, and not putting creditors of the company in a position where they can come and tap your shoulder to make good on a prior debt.
Okay, good. And then I know that there seems to be a conflict of interest in what a buyer prefers and what a seller wants to get out of it, and whether it's a stock sale or an asset sale. Can you kind of go over some general rules?
Well, general rule, pretty basic. Buyers want to buy the assets, and the sellers want to sell the stock. It's really, at a 10,000-foot level, that direct and straightforward. The reason that the buyer wants an asset sale, well, a couple reasons. First and foremost, to know that they're not going to get stuck with unknown liabilities at the end of the day. They can pick and choose the liabilities, and as noted before, that's sort of not the situation with a stock sale or a stock purchase. The seller wants to maximize their net after-tax recovery, and they're in a far better position to do that in a stock transaction than they are in an asset transaction.
Okay, great. And let's see. Why don't you go into some buyer issues?
All right. Buyer issues, and I can't emphasize it enough, is that all the liabilities, known, unknown, remain with the corporation if you do a stock sale. That's the foremost buyer issue. To put it in perspective, anytime a buyer client comes into my office and says they want to do a stock transaction, I jump up and down and say, no, you don't. We're going to try to do this as an asset deal because you just never know. Things can go wrong. Even with the best intended seller and the best run business, there are always potential liabilities out there. Why put yourself in a position where you might end up having to pay for those at the end of the day? Just don't do it if you don't have to. Sometimes they'll say, the heck with it, I need to, I'm going to, and we try to protect them as best they can, but they're going to get, I'll call it speech 1A for a buyer, which is do not buy the stock.
Mm-hmm. And if a seller walked in, you might, if it's going to help them tax-wise, you might advise them a little differently.
Absolutely. If I'm the other side of the transaction, I want a stock deal every time. I guess with an S corporation, I'm not going to be that hopped up about it, because in a stock deal, I'm going to presume that my client has had the stock for over a year, and the stock is a capital asset. When the stock is sold, hopefully for a gain, they're going to get long-term capital gains treatment on that. As opposed to double taxation. That's the I'm sorry, I've jumped ahead already to the other side of the equation.
We'll move with you.
All right. So here's the basic deal. Again, I'll throw the disclaimer. I'm not the tax advisor. I'll always want to work with a tax advisor irrespective of whose side of the transaction I'm on. Give you a difference between this references a C corporation. Hopefully not to be too technical. If you have a corporation, it's going to elect a tax status by default to be a C corporation, meaning it's taxed under subchapter C of the Internal Revenue Code. Or in some cases, it can elect to be taxed under subchapter S. The base difference there is that an S corporation, and mind you, it's the same corporation. There's really no distinction other than the tax treatment. But an S corporation is a tax pass-through entity. So there's one level of tax with certain exceptions. The profitability of the corporation flows through to the shareholders and they're taxed at that level. But if you're a C if it's a C corporation that is selling assets, the corporation is going to have a tax that's called a 35% tax rate at the corporate level. Then in the situation where the sales proceeds are passed through to the shareholder, which is where you ultimately want them to end up, the shareholder is going to get hit again. This time, the level of tax is going to be long-term, presumably long-term capital gains, looking at a 15%. So you're looking at a cumulative 40% tax if you're doing an asset deal in a C corporation. A bit of an aside, I just checked, and the deal that was struck between Obama and the GOP yesterday looks like it's going to end up maintaining the long-term capital gains rate at 15% for the next 2 years, assuming that gets approved. I threw in the
wonderful.
Might revert to 20%, but right now it's looking like it won't.
That's good news.
Again, working down the area that I shouldn't be in, which is tax, distinguish that 40% rate from a stock sale where you've got gain that's long-term capital gains. You eliminate the 35% tax at the corporate level. Much, much better, therefore, for the seller in a C corporation to do a stock deal as opposed to an asset deal. We're looking to maximize the net return at the end of the day. It means minimize the taxes. Not such a big deal if it's an S corporation. Again, an S corporation is a tax pass-through entity. There's only one level of tax. So the corporation sells its assets, hopefully has a gain. That gain then flows through to the shareholder, and if I get it all correctly, the shareholder then is taxed at a capital gains rate on those gains. Good.
Okay. Well, I know tax is the key issue that most buyers, especially sellers, are looking at. It's what you walk away with, correct? So if you can kind of touch on goodwill, non-compete, and how those are treated in an allocation, that would really be helpful.
Let me give that a shot. Just like the buyers and sellers are at odds over a stock deal versus an asset deal from a big picture perspective, one of the key elements in every transaction is the allocation of the sales proceeds to various assets acquired. And I use the term assets acquired because that even applies in a stock deal. A stock deal, one of the assets that you're going to want to preserve is the goodwill. That means that you're going to presumably have non-compete covenants. Who provides the non-compete covenant and what's the allocation for that versus allocation for equipment or allocation for goodwill? This is a little bit different than saying asset deal versus stock deal. although there are some crossover elements to it. Well, we can start with the concept that generally the buyers and sellers are going to want the allocation to go to different places. For a buyer, if I pay $100,000 for assets or $100,000 for stock, that purchase price is a capital investment, and I don't get to deduct that. It's just out of pocket, no deductibility at all. There's a bit of a difference, moving down one bullet point, if I can allocate part of the purchase price to goodwill and non-compete payments. Those payments for those intangibles are subject to 15-year amortization. 15-year amortization. That's not great. I'd rather deduct it in year one. I'd rather deduct it over 5 years. But if I get 15 years versus nothing at all, I'll take the 15 years. From a seller's perspective, compensation payments such as, well, strike that. Let me make a bit of a. I've jumped ahead of myself. As a buyer, my best solution is, instead of allocating purchase price to specific assets, including goodwill or non-compete payments, is to allocate it to compensation. Have an agreement with my seller, whether they're the shareholder selling shares or whether they're there's an asset deal. Have an agreement with my seller principal to stay on board in some theoretical capacity as a consultant and pay part of the purchase price as consulting fees or possibly even in salary. That becomes completely deductible to me as the buyer. I want to stuff as much money into compensation as I possibly can. So those are sort of the priorities of preference, compensation being the highest, goodwill and non-compete second, other purchase price third. Well, those being my objectives as the buyer or ideals, it works backwards from the seller perspective. Compensation and non-compete payments are ordinary income to the seller, not capital gains. It's just you pay your tax. Not a good situation there. There's a bit of a proviso for personal goodwill. If I, as a seller, can allocate payment to personal goodwill and establish that I have personal goodwill, I can take that as capital gains. And I'm using the term personal goodwill. I probably confused some people. It used to confuse me a lot. Goodwill is defined as the expectation of continued patronage and profitability. A business entity, by virtue of its name, hopefully has goodwill. There's also goodwill that can be attributable in some cases to the individuals. Hopefully here in my practice, although I'm a shareholder in a professional law corporation, I would have personal goodwill that if I had a non-compete covenant, well, I guess I can't say non-compete, where I might sell my personal goodwill, and instead of receiving payment for that as ordinary income, I'll take that as long-term capital gains. But that's what I would like to have in that situation.
And Brad, is that you can only do personal goodwill when you are an integral part of your revenue stream? I mean, you're the one producing it.
Yes. I don't know of any other situation where you could take personal goodwill. It's otherwise going to be entity-level goodwill, and that's going to have differing tax consequences.
Okay. Okay, thanks.
Here's where we've got the crossover on the next bullet point to a situation where there's goodwill involved in the transaction. If I'm the seller of a corporation, or if I'm doing business through a corporation, what I'm going to want to do is take everything as payment for my stock. I don't want to look at ordinary income as a consulting fee or as salary and have an allocation of those items. I want everything allocated to my stock. This is where I'd prefer to do a stock deal as opposed to an asset deal, because I'm going to take that compensation or in the form of payment for the stock and have long-term capital gains, 15%. And this could drive me to fight really hard to do a stock deal. In exchange for that, I might have to give up a fair bit in the way of representations, warranties, indemnities, holdbacks, offset rights, and the like. But at the end of the day, if I want to maximize my recovery net of taxes, stock deal all the way.
Now, Brad, does that apply whether it's a C Corp or an S Corp?
Well, I got to put on my CPA hat here that I don't have. No, I think I'm only looking at that in the C Corp environment.
Right. Okay. Just wanted to clarify that. I'm pretty sure. So if anybody on the phone is an S Corp, it isn't as important to do a stock sale versus if you're a C Corp, if you can get a stock sale agreed to, that's the better way to go.
I might do a little bit of an aside here. Again, I'm stepping out of my role, which is if you've got time and to prepare for and plan for your sale, I can consider, can you convert to, should you start, or can you now go to an S corporation? There's some holding period issues that are fairly extensive. But if you're not looking to sell right away, depending on how your assets are structured and where you might realize gain, being an S Corp could be a good thing, which would then let you sell the assets and minimize your overall taxes.
Mm-hmm. I've even had sellers feel so strongly that were C Corps that they wanted a stock sale that they adjusted the purchase price, because they're saving a great deal from that they split the difference with the buyer.
I've seen similar situations, and yeah, it can be significant savings.
Man. Are we ready for the next slide?
Yeah, let's go there.
Bottom.
Well, to sort of take a half step backwards, to the extent that you've got an allocation for an intangible such as goodwill or non-compete payment to the C corporation, now you've got sort of the worst of all scenarios. You've got a tax presumably at the corporate level, proceeds flow out to the shareholder, and taxed again. And we're right back to that 40% tax bracket, or cumulative tax bracket. Not a good place.
Oh. Okay, I know there's some other points that you wanted to touch on that can definitely change the deal. Touch on those.
All right. I call them deal-changing issues. One would be licensing. We do a fair number of transactions with contractors, and what you need to have is a contractor's license. If you engage in business at any time without a contractor's license in place, you've got a problem. It's a misdemeanor, and your customers don't have to pay you a dime, even though you've performed perfectly. So it's a big issue to deal with when we're dealing with a contracting business. Great challenge is that it takes a lot of time to get a new license. If I come in as a buyer and I'm not set up with a license, I'm presumably going to want to buy the assets, which means I'm going to form a corporation to be the purchaser of the assets, and I'm going to then need to go get a license. That means I need cooperation, presumably from the seller, to operate as my qualifying individual to go to the Contractor State License Board and get a license for my newly formed corporation. It used to be that was a 4-month plus process. I'm not sure exactly how long it takes now, but it's still a time-consuming process, and one of the things that you don't want to have in a deal is wasted time. Deals, you want to get them done. So that length of time, the need for cooperation from the seller, who doesn't necessarily know that I, as the buyer, am going to complete my deal, which can also be a bit of a problem, makes licensing, particularly for a contracting business, extremely difficult. One of the ways to deal with that is to go to a stock deal. The license for a contractor is held by the corporation. And if I, as the buyer, buy the stock, I've gotten around that whole time-consuming process. As the seller, I would potentially or would like to do that. Of course, I want to sell the stock anyway, and I'm going to get a quicker, easier deal. The big challenge then becomes for the buyer dealing with all of those potential unknown liabilities, one of which is the prospect of a limitations period on defective construction that lasts for 10 years after the work is complete. So we end up doing a fair bit of work to protect a buyer in that context. But the licensing, the point being, can drive everybody to do a stock deal where it would be the transaction would typically be better handled as an asset deal. Another deal changer is real estate. I would never do a deal as a buyer where there's real estate involved where I'm taking over the selling entity. The reason for that is hazardous materials. The cost of cleanup can be extraordinary, and anybody who ever gets into the chain of title has responsibility for the cleanup. So if the corporation or LLC, whatever the entity is, has owned the real estate, I'm going to buy that real estate as opposed to the entity. It's just a non-starter to buy the entity.
And Brad, I know many people, will hire somebody to do a phase 1, and then it may go to phase 2 or 3 to protect them. You don't think it's still enough?
From a lawyer's perspective, never.
Really?
You can get some level of comfort, and it's a rare occasion when things really go wrong. But from my perspective, and maybe I'm just too conservative, I look at the potential liability is so great that if it was to occur, even with a low probability, I'm going to scream and holler at my client not to take over unless I know for certain that there's no possible way that there was ever any contamination. And as a lawyer, I always presume that there was. Okay,
and so you're going to recommend in that case an asset sale?
Yeah, it doesn't mean I control the deal.
Right.
And I've made many a recommendation that's not followed, but there's going to be an awful lot of resistance from me if there's any risk at all that there was contamination.
I agree. And what about the warranty issues?
Well, warranties, hopefully materials that are sold or services provided or construction that's performed is without defect, and warranties don't come back and bite you. But the idea is the warranty protects the buyer of the product or the party taking the benefit of the services, and you just never know. I mentioned contractors. They effectively have residual liability. It's not technically a warranty liability for up to 10 years. It's those situations. You could have all sorts of. Let's say you were manufacturing ladders, automobiles, lots of things that could result in tremendous harm if there's a defect. In a transaction, I'm going to look at what representing the buyer primarily. I'm going to look at what the potential exposure is, what the likelihood is, and do an analysis as to how can we protect ourselves. I'll take several steps back to the comment about a stock deal being structured so that it kind of looks and feels like an asset deal in terms of the allocation of the liability exposure. If there's warranty exposure potential or product liability exposure potential, I'm going to want to stuff that over to the seller. Then comes the rub. Can I provide in the transaction sufficient protections? That is, I can have a contract that says selling shareholder will be liable for all of these unknown or contingent liabilities, whether they be warranty or otherwise. But if I don't have something to back that up, the writing on the paper is not worth anything. And sometimes you just can't get enough backup to be able to justify taking the risk. And I've seen various transactions where we would have liked to have gone with a stock deal for whatever reason, including that's the way the seller wants to do the deal, and we avoid the common enemy, which is the government collecting our taxes. We just look at it and go, can't provide enough protection, therefore if we're going to do this deal, we're going to do it as an asset deal and not assume the liability exposure.
Okay. So it really depends on the business and the industry. And
absolutely. Each situation is different. This is I throw this in really because it's a potential issue that could drive you towards an asset deal where everybody would otherwise want to do a stock deal.
Mm-hmm. Okay. And then there's some other factors in a business sale we should touch on before we close.
Yeah, I'm not sure that any of these would drive you to one form of transaction or another, but they are things that come into play. Employees and vacation liabilities and worker comp rates. If you're doing an asset purchase, what happens at the end at closing is technically all of the employees of the seller are terminated, and then they're immediately rehired by the buyer. That's the technical result. Well, in California, what happens when you terminate an employee is that you then need to cash them out of all their accrued vacation time. That's a horrible thing for the buyer because while the employees are happy to receive their vacation pay, in the next couple months they're going to want their time off too. So that it creates a bit of an issue. Oftentimes what I'll do, and it's not necessarily the right way to do it, but from a practical perspective we'll do it anyway, is have the buyer in the transaction actually assume those liabilities that should have been paid off. Workers' comp rate. You can have a really good workers' comp rate. You can have a bad workers' comp rate. If you do a stock transaction, you take over that comp rate. And I guess I failed to say that in a stock deal, dealing with employees, there's not even a hiccup once you buy the stock. The employees are still employed on the same terms by the same employer. Really easy way to go about it. So if there are material issues with employees, you might want to go with an asset deal. If not, then a stock deal might be more appropriate.
We're saying about the vacation liabilities that it might be better in a stock sale for the buyer to assume those liabilities, meaning the seller at closing will credit back to the buyer what that dollar value was, but he will continue with it?
Yeah, you look at it as a liability. You adjust the purchase price for it accordingly, and it doesn't impact anybody's cash flow. It leaves the employees in a position in doing a stock deal. You end up in the same or correct economic result in terms of the purchase price. The employees are still going to get their vacation, and nobody's out the cash flow. It's a great approach to look at it as a stock deal as opposed to an asset deal to avoid the challenges of dealing with the employees in an asset deal.
Good idea.
Let's see, again out of my area, basis and assets for depreciation. Lots of businesses get sold, people looking for their cash out upon retirement, and they're sitting on assets that were long ago depreciated. They've got a tax basis of 0. If a buyer comes in and buys the stock, they're effectively taking over that tax basis of 0. And guess what you get to do if you do an asset deal? Allocate a bunch of money to the tangible assets, create a basis, and depreciate those same assets all over again. So that's one of the benefits to a buyer for doing an asset deal, but it gets back to the issue of allocation that is often forgotten until the last minute. So a good thing to think about in advance is how you want the allocation before you approach the sale.
And Brad, isn't it true that if it's a stock sale, you do not have to allocate? You only need that if it's an asset sale?
That is correct. But in the stock deal, you don't get to depreciate again.
Right.
Sales taxes, another factor, and it depends on the type of business. If I'm a service provider, I'm not going to be paying sales taxes. Therefore, I can claim that I've got a one-time sale exemption if I sell my assets, and I can sell all of them, and there's no sales tax that applies. But if I've got a business that otherwise pays sales taxes on the portion of the purchase price in an asset transaction that's allocated to furniture, fixtures, and equipment, that's the FF&E, somebody is going to pay the sales taxes. It'll be, it can
Particularly
be allocated.
The buyer.
Yes. There might be credits for that. You can still work out the economics, but there's another cost of doing the transaction simply because it's an asset deal as opposed to a stock deal. next bullet point, consents to assignment of agreements. If I'm doing an asset deal, there's a likelihood that some of my key contracts will have provisions that say that the consent of the other party is required to effect the assignment to the buyer. That can be a challenge. Not nice to go to your key customers and say, hey, I'm going to sell my business. Will you please consent to the assignment of my contract to my new buyer? That's a detriment in some cases to doing an asset deal. Stock deal, you generally don't have that issue. But beware, keep in the back of your mind that most leases, for example, are going to consider a change in control of the corporation as an assignment and therefore require consent to the assignment. Truth be told, we don't always go and get that consent, but the need to get a consent can be a particular issue in an asset deal.
What I found in that, in the real estate assignment is that the landlord will most often want the buyer and the seller to be on the hook for that if they're assigning it versus creating a new lease. Have you found that as well? They want both?
Yeah, absolutely. The general rule with an assignment is that the assignor, the party who's making the assignment, is going to remain liable as a guarantor. The assignee, the person or party obtaining the assignment, is then going to assume liability. But in the mix, if I'm the landlord, I want individuals on the hook. And I might withhold my consent unless I get some money on the side or other guarantors, and then I improve my position. I've seen landlords become a real problem in a deal.
Yep, they can be. That's why I always recommend a seller after they decide to put their business on the market to start talking to the landlord. They have, the right to complete their lease, so everybody worries about the landlord knowing ahead of time, but I found that it works better the longer they know about it and get used to the idea and find out what the criteria is for the buyer, whether it be a net worth or whatever. That makes it easier going down the road.
Makes sense.
And the bulk sales process?
I'll refer to that as a pain in the neck. Under the Commercial Code in California, Article 6, any business that is involved in the sale of goods from stock, which would by definition be retail businesses or where distribution businesses, and also including restaurants, that sells most of its assets, I think it's defined as more than 50%, is required to go through the bulk sales process. That's a notice in the newspaper where people can find out that you're going through a transaction that you might want to keep confidential. Notices to taxing authorities, and in some circumstances, escrows. It's how to put it, it wouldn't stop you from doing a deal. It can create some hiccups. If there are particular issues of confidentiality, it could drive people to say, I don't want to do an asset deal. I want to avoid the bulk sale process, so let's do a stock deal. There are folks that will go ahead and do their deal without bulk sales compliance. The challenge there is that if you've got a transaction, and it would only be an asset transaction, that is subject to bulk sales, and you as the buyer do not go through that process, you are liable to the creditors of the buyer, of the seller for a year period. That's a risk that I would typically not want to take. If you're doing an asset deal for purposes of avoiding the assumption of the seller's liabilities, it pretty much defeats the purpose to create a statutory liability to creditors by not going through the bulk sales process. And the bulk sales process is just sort of a nuisance.
The only problem that I've ever experienced with it, you've had maybe more experience with it, but is that when the tax boards or whatever sends a notice to the company, saying that they recognize it's for sale or whatever, an employee sees that notice, then that shows your cards before you maybe wanted them to see it that, that the business was for sale. But if you can put a home address or some other address on there that it goes to the seller's home versus the office. But that's the only, the thing I don't like about it, it just draws things out because you have to wait 12 business days, and it takes a couple days to get it published. So, you're up to maybe 15 days longer than a close might have to take.
Yeah, I can't say that I've had anybody. The issue that I typically see is with the sellers not wanting the sale to become public until it's closed, because they don't want their customers to find out, don't want employees to find out. And by definition, in the bulk sales notice, there's a publication in the newspaper. But I can honestly say I've never had a situation where we've gone through the process and somebody has found out about the transaction other than the means by which you just mentioned, Joan.
Yeah. The escrow company that we use uses a business publication, and it's one of these business publications that no one sees. It's mainly for that purpose, just this list of businesses for sale. So they don't put it in the Mercury or in the San Francisco Chronicle. So that hasn't been an issue for me.
Yeah.
Yeah. And then the built-in capital and credit?
Well, if you do an asset, strike that. If you do a stock deal, presumably you've got vendor relationships that are pre-existing, and those are going to continue. So you've got credit, and one of the great things is when you're doing a stock deal, you're typically buying a balance sheet, which is going to maintain some required working capital. So unlike a situation where you're doing an asset deal where the I'm getting back and forth there, the seller is takes the cash with them. By doing a stock deal, you can be in a better position. It might be somewhat easier to facilitate having capital and credit as opposed to an asset deal where you as a buyer get to start funding the capital requirements of the business, and you're probably out there trying to reestablish credit with vendors.
Mm-hmm. Yeah, that's a big advantage to a stock sale for both, really, mainly for the buyer, isn't it?
Yes, absolutely.
Thank you so much, Brad. I see a few questions. I thought you did an excellent job in clarifying some of those for us. We had a question from one of our listeners who has a contracting license, and his question was, is if the RME, which is responsible managing employee for those listings, stays with the company after the sale, would that minimize issues with the contractor's license?
I think the short answer to that is yes. Whether it's a stock deal or an asset deal, you're going to need to make arrangements typically for the RME or RMO. That's RMO is responsible managing officer. They would typically, they can stay on in either capacity. They're also referred to as a qualifying individual. If they leave, then you need to replace them within 90 days, and that's generally going to be an issue. So you typically make arrangements with the qualifying individual to stay on for a couple of years so that the new owner has the ability to get the experience required to obtain their own license and thus become the qualifying individual. That typically means further indemnities as between the buyer and the RMO or qualifying individual. Insurance coverage, we've got a fairly standard agreement to make that happen. But yeah, it definitely makes it a whole lot easier. If you don't have a qualifying individual on board after the sale, you really can't do the deal.
Okay, thank you. And then another individual said earlier, were you discussing allocations under a stock sale? And I think we were referring that to an asset sale. Is that correct?
Generally speaking, you could still, in an asset transaction, you're going to have to dump the purchase price someplace. When I say dump, allocate it to some category of assets, whether it's equipment, furniture, intangibles, non-competes. You can still have a situation in a stock deal where if I'm a buyer and I'm looking to tie up the principals as shareholders, I can I'll want to enter into direct non-compete agreements with them, in which case I'm going to take what would otherwise be part of the purchase price and allocate it to the non-competes, if for no other reason than to have solid consideration to support the non-compete contract. So there is a titch. It's not the same issue, so it's really an asset purchase issue, but there is a bit of an element there in a stock deal.
Okay. Creatively, another question was, creatively speaking, can a C Corp sell assets to a closely related company for zero net gain, then sell those assets to a buyer plus the stock, which is now worth very little?
I'm raising my white flag on that one.
That's the first. I haven't heard that idea.
Well, I think it was a Clint Eastwood that says a man needs to know his own limitations, and that gets into some tax issues that really are beyond my expertise.
Okay.
So I'll just sort of decline to even try.
Was there? I'm going to take the group off mute in case there's anybody else that would like to.
The conference has been unmuted.
Michael joins us right now on set.
I'd like to ask Brad a question.
Actually expound on what the strategy is, but it does sound like
Good. And it, you want to take them off? It's kind of noisy. Okay,
The conference has been muted.
That ends our webinar. I want to thank everybody so much for getting on, and hopefully it was helpful to you. If you'd like to refer this webinar to anyone, you can tell them to log on the Sunbelt website, which is sunbeltbayarea.net, and there will be a link to our webinars, or if there's something you'd like to hear again, feel free to do so. Thank you so much, Brad, for helping us out today. Brad, thanks so much for helping us out today.
You're very welcome. My pleasure.
Okay. Bye-bye.
Bye-bye.